let's say 5 years out, we find ourselves in this protracted, this long recession that's borderline depression. There will be a point where it gets so bad, they will have to go back to that, what they do best, which is printing money to stimulate growth. So my guess is that we haven't seen the recession yet hit, but it is going to come in a big wave, and it's going to be nasty. It's going to be one of the worst recessions that we've seen probably since 2008, 2009. I think there will be areas of the world that don't get hit as badly. I think some of the emerging markets, whether it's China or South America, they could hold up a little bit better. Their economies, you could argue by looking at their charts of their main indices.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets. According to Soloway, Bitcoin may face a lot of uncertainties in the near term as a result of the ongoing global economic declines, and we can still possibly see the Bitcoin price drop to 12K even lower, before putting it at a bottom. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed. Before listening to him, please ensure to smash the like button and subscribe to the channel.
I think the biggest issue here is, and the reason why it was such a big impact, is because it's the first sign that Japan is actually willing to budge on this policy of theirs, where they've been at basically zero interest rates for so long. So I think it's not the 25 basis points that's really the shock. It's that they actually moved at all, which seems crazy, but they've been in this kind of policy of no interest rates at all for such a long time. And now it looks like it's starting to change. The only thing I can think about is that, does this signal some bigger trend of a slower macro economy, right? So if Japan is moving because they're seeing certain things, not only inflationary, that are causing them to make this move, does it speak to a larger trend of large economies beginning to weaken? And does that eventually mean that the US dollar will fall because stimulus may have to come back at somewhere in the future? I mean, is that the end goal? And how many years out? Who knows? But you're right. It is interesting to see the dollar fall. I think the biggest kind of switch that I saw is this, if you go back on monetary policy, whether it was the Federal Reserve or Bank of Japan or Bank of England, I mean, there was this kind of pressure cooker where they always wanted to keep asset markets up because they felt that wealth effect was working. And then what we saw is over the last 10 years, the rich got richer and the poor didn't really benefit as much. If you didn't have investments, you didn't make much money. Wages were stagnant, all that. Now, all of a sudden, what we've seen is this kind of rotation of thought process where they're saying, okay, we have to start paying attention to inflation because that's what the poor and middle income people are really being affected by. I mean, they're getting poorer because prices are going up. They can't afford that. So you have to kind of look at it like, okay, so forget about the people that have money already. How do we start dealing with the poor in the world? I do think it's going to be a tough battle to fight. And I think we have to look at how the trend has been, right? So we've been under trend of inflation for many years, which then usually means to get back to the medium or the mean, we have to have a multiple period of years above that goal of 2%. And I think that's what we're going to see. But having said that, that would generally indicate the Fed would be unlikely to stimulate. I would argue that in the beginning, for the next few years, the Fed will be really hesitant to print any money or lower interest rates because inflation is going to be sticky north of 2%, whether it's 3, whether it's 4, I'm not sure, but they're going to be not wanting to trigger the inflation bug again. However, let's say 5 years out, we find ourselves in this protracted, this long recession that's borderline depression. There will be a point where it gets so bad, they will have to go back to that, what they do best, which is printing money to stimulate growth. I do think they've gone a little far. And again, part of it, I think, is human psychology. The Fed, when it comes down to it, everyone looks at the Fed and says, oh, they're almost superhuman. They're these great, bankers and everything. But in reality, they're humans and they have emotion. And I think they got way off sides on the transitory call. They feel like they have egg on their face from that call. And I think they kind of overreacted and said, oh my goodness, we were wrong. Now we have to prove that we're tough on inflation. And they've gone a little too hard, too fast in the opposite direction. So my guess is that we haven't seen the recession yet hit, but it is going to come in a big wave. And it's going to be nasty. It's going to be one of the worst recessions that we've seen probably since 2008. 2008, 2009, and it's likely going to last a lot longer, mainly because the Fed won't be able to stimulate us out of it in the early portion. So, I mean, really, I've gone on record and said I don't think the S&P will make new highs for 10 to 15 years. I still think that's very logical. If you look back at the dot-com bubble, it took the NASDAQ 15 years to make new highs. And here we are seeing the amount of liquidity that was in the markets, the bubbles in crypto, in stocks like AMC and GameStop. It's very, very similar. And without the Fed stimulus, we could be looking at 10 to 15 years before new highs are hit. I do think, honestly, I'm in a camp where I think the dollar has probably made a longer term high pivot. In fact, let's take a look at the charts here and kind of get a gauge on that. So what we do is if we look at this chart on the US dollar, the DXY, we can clearly see that you were trending up. And interestingly enough, if you can connect these highs and look at that, I mean, basically the high was right into that level. And I love trend line analysis because what you can get from trend lines is that every time it hits, you get some sort of pullback. And in this case, it's been a much bigger pullback. Oftentimes when you get this kind of triple-headed monster right here, that's the sign of a bigger top forming versus what we had over here, which was just an up move, pullback, and then new highs, obviously. So to me, I look at it and I say, the Fed is now stepping down on their rate hikes. We just had a 50. It's likely we'll get a 25. As the economy weakens, we're going to get less and less hikes and probably even just more of a neutral policy, meaning no more hikes. And I think that really makes the dollar a tough to sell for, or a tough situation to make new highs in the near term. So I'm in the camp anyways that I do think we likely will see the markets, or at least the dollar, having topped out here. And that's going to be very good for metals like gold and silver. I think it'll be phenomenal, in fact, for gold and silver. I think there will be areas of the world that don't get hit as badly. I think some of the emerging markets, whether it's China or South America, they could hold up a little bit better. Their economies, you could argue by looking at their charts of their main indices, they've actually been consolidating now for 14 years. You haven't had new all-time highs. I mean, speaking of what I just said about the US markets maybe not making highs for 10 to 15 years, those markets haven't made new all-time highs in 14 years. And so I think there's certain pockets where money will rotate out of the US, but I think the US is now on a downturn that will last a very long time. It will likely spread to the European Union, the UK, and maybe even Japan to some extent, although depending on their policies, maybe not. But ultimately, I do think that it's going to be something that is mostly global between the big powers. I definitely think in terms of the dollar, I mean, that's where the ultimate outcome is, right? So you have a couple negatives working against the dollar. Number one is the Fed is now going to more of a no raise policy. So we know when the Fed was raising rates, it was strengthening the dollar massively. As soon as they kind of toned it down a little bit, we saw the dollar pull back. Now, eventually they'll print money, but that's going to be years away, right? They're going to hold out as long as they can until the economy demands it because it's in such bad shape. But I think the other factors we have to remember with the dollar is that you also have other countries starting to look to take over that reserve currency as well. And if the reserve currency starts to be, let's say in digital yuan or something else, there's a whole lot of dollars that countries around the globe hold, and we're talking trillions of dollars that they can then dump on the open market, which will also add to that negativity or downward move on the US dollar. So I do think that, again, the dollar eventually is dethroned. It's one of the reasons why eventually I do think crypto, or at least Bitcoin, becomes intriguing as a store of safety, at least a digital gold, to kind of offset the dollar decline. But yeah, I mean, it's going to be, the next 5 to 10 years is going to be unbelievably fascinating and kind of scary, frankly. You're just starting to see little inklings of that. We've heard about China, buying oil in digital yuan now, and various other countries starting to speak up about how the US dollar shouldn't have the power that it does over other countries. So I think that that's beginning. I don't think it's going to be a rush to the exit just yet. Usually, just like stock markets and other things, the crashes occur at the end of the move when everyone finally realizes that it's in trouble. So I think for the next few years, it's going to be a slower decline with bounces, but it will get faster and faster towards the end. And I think if you're in the US like I am, I have to be very aware of how I diversify away from dollars.
What do you think the markets look like for this coming year?
Yeah, so I'm in that camp where I do think we see some pretty dramatic downside in 2023. So just showing my SPY chart, one of the coolest things, again, talking about trend lines here, this is the all-time high on the S&P. Here's the first hit of that line. then you hit it here, and you gapped above it when we got that CPI number last week, and then we sold off. And what I love about that is it's such a negative signal. When a chart opens above a technical resistance point, it has every chance to break out. And if it doesn't, that's like a double negative. That's about as bad as you can get. And we saw that reversal on the back of that CPI number. We then had the Federal Reserve the next day, and obviously the continued sell-off that we're seeing here. So that was the negative aspect here, where I think short term, this has to be looked at as a major top. The next step is to say, okay, well, what happens in 2023? So you have to start thinking that we will see an official recession on the books. How does that affect earnings growth if the consumer really starts pulling back? I don't think that stocks have factored in the lower earnings growth or the negative earnings growth that they could see. And then you have to start to say, okay, well, if the Fed is not going to bail us out from a recession, how bad could the markets take that? And in the very least, I would not be shocked to see this long-term trend line here going back to 2016. And you could even extend this. I mean, this is what's amazing about it. We could extend this back to basically 2009. And that's kind of my target for 2023. So we're looking at about 800 points on the S&P to the downside, or maybe just a little bit less, 75, 80 points. In this case of the SPY, which I'm looking at, that's about 74, 75 points. But it's a big percentage move. I mean, you're talking, 20% probably at least. You'll start seeing some realization that money can flow in there. So I think that's going to be one of the key things that actually puts a bottom in for crypto. I do have it priced in. I still think Bitcoin goes lower. 9,000-ish is what I'm looking at right now. I think that is achieved by May or June of 2023. And then I think you're going to start to see a flip with regulation. People and investors, and this will even be myself, if I'm looking at stocks and I'm saying, okay, these companies are going to earn less and less because we're in this long recession and the consumer's not spending as much. Well, where do I put my money? Well, now Bitcoin starts to look attractive. You got the transparency. It's become the digital gold. Maybe that's where I put some of my money. And I think a lot of other big firms will go that route. I have my emergency stash, which is physical gold and silver. And again, it's not a lot. I don't hold a lot because, it's more meant if I wake up tomorrow and the internet's down and the banks are closed and like I have no cash on me and my credit cards don't work. Well, how do I, pay for things? How do I do what I have to do? And the answer is physical metals would then take that place, right? Either that or the barter system. So that's a small percentage. Aside from that, I mostly trade in and out of the GLD, GDX, the SLV. So I'm using the ETFs to really trade it. I don't do the futures quite as much. But again, those ETFs are really my main swing trading opportunity. So here on the GDX, and again, this is your monthly chart, but the monthly chart's nice because you actually see that consolidation pattern, right? You can almost have these two parallel trend lines that mark the highs and the lows. And notice how we were just down here and we started to move up. And now when you have this move from the low of 2020 straight up, this now becomes what we would refer to as a in spirit of bull flag. Now it's the monthly chart, so it's going to take some time, right? If we go to the daily chart and I zoom out, you can kind of see that in a different light. But basically you have to come up and test this high end here on the GDX, which is just underneath $40. But that would be your breakout where you would get a big move to the upside. All right, so again, we have the bullish pattern on the longer time frame. Then you look at a couple things so the miners underperformed pretty dramatically gold this year because their inflation input costs were soaring and gold was not going up, right? So, I mean, think about that. Imagine you're mining gold. It's stuck at around, let's say 1,700, 1,750 was the average price in 2022, but all their costs were going up. Their equipment cost more. They had to pay their people more. So it really put a lot of pressure on the miners in 2022. Now, the key is going to be this. If I'm right and the inflation pressures come down to, let's say 3%, but just stay there, but gold starts going up 10, 15, 20%. Now the gold miners are in an unbelievably sweet spot and they should actually outperform. So I think the chart is kind of telling us that something like that is on the horizon. It still may be months away, but it certainly is interesting to kind of note how we're getting to that period.